Welcome to CFTC Talks. I'm your host, Andy Bush, Chief Market Intelligence Officer for the CFTC. Hey, just a quick reminder, as always, there's a disclaimer at the end of the show that's important for you to listen to. And also, just as a reminder, this week's show is part 2 of my interview with Chairman of the FMSB, Mark Yallop. In this part, we're going to talk about how the FMSB gets members to follow the standards without fining them. That's pretty tricky to do. And of course, the wonderful research they're going to be releasing on bad behavior in the financial markets going back to 1792. If you don't think that's interesting, you don't know your history or what was happening when Alexander Hamilton was the U.S. Treasury Secretary. Please enjoy part 2. There should be an environment in which everyone's operating under the same rules, right? That's what we're trying to get to, and that those rules are fair and effective. And I think that's what's really great. One of the things that the FMSB has done, and I love this, is that you did some research on bad behavior over time. And you looked at market misconduct going back to, I think it was like 1792, if I'm correct. And you found that history repeated itself quite frequently. And there were about 7 categories that kept coming up over time. Just briefly, what was that like to do that research? Was there anything that kind of surprised you, or I guess there shouldn't, but I mean, the 7 categories must have been interesting to develop.
Yes, so this arose from a question I asked the team here when I started a couple of years ago on this project, which was one of those disarmingly simple questions that turns out to be rather harder to answer than you'd hope, namely, is there something we can learn from history about the way in which misconduct in markets happens that would be useful to guide our thoughts about standards in the future? And so we pulled together a database of all of the cases of market manipulation that we could find, stretching back to the earliest days of the modern capital markets across multiple jurisdictions. Hundreds and hundreds and hundreds of cases, starting in 1792 with the first actual manipulation of the U.S. government bond market in 1792 by a chap called William Durr, who was actually the Assistant Secretary to the Treasury at the time underneath Alexander Hamilton. He squeezed the U.S. government bond market with a group of co-conspirators, and actually ended up in jail and died in prison about a dozen years later. So that wasn't a very successful scam. And that was followed over the years by multiple other examples, stretching up to many celebrated more recent cases like the LIBOR and the foreign exchange cases that people are familiar with more recent. We looked in total at 26 different jurisdictions around the world, starting with the US and the UK, but then moving way out beyond there over this, as you say, 235-year period. And what we realized after a while was that there were not dozens or hundreds or even thousands of different ways in which people have, over the years, manipulated markets. There are, in fact, relatively few distinct manipulation techniques which people have copied and transferred from one market to the other. So what appeared in the commodities markets got copied over into the rates markets, into the credit markets, into the equity markets. What happened in the US happened also in Europe, happened in Asia. What happened in voice markets has been repeated in electronic markets as market structure has evolved. We concluded when you looked at this history that there were in total, in fact, about 25 distinct techniques out there. So by technique, I mean something like spoofing or layering or ramping, squeezing, insider dealing, manipulation of benchmarks, wash trades, match trades, front-running, techniques like that. We grouped them, as you mentioned, those 25 distinct techniques into 7 broad categories, which you might describe in the following way. So there's a group of 4 or 5 that all really amount to manipulation of prices in markets. There's a group of 3 or 4 that really come under the category of using inside information. There's a group of 4 or 5 techniques which are used for manipulating reference prices, closing prices when at the end of trading in the trading day on exchanges or in at reference times of the day in OTC markets. There's a group of techniques that are we categorize as under the heading circular trading. So this is where people are A trades with B and B trades back with A. The net economic effect is zero, apart from the transfer of money from A to B or B to A, depending on how the trade is structured. So it's creating the impression of trading activity, but really just with money passing from one party to the other. There's 4 categories, and then the 5th category we found was collusion. So people sharing information amongst a group of conspirators, if you like. Then there's a category called improper order handling. So that includes things like front running or cherry picking, partial fills, and all that sort of thing.
Right.
And then our last category, the 7th, was misleading customers, which involves techniques like giving guarantees or which are not disclosed to other people in the market, window dressing and misrepresentation, things like that. Mm-hmm. So those were the 7 categories. It's obviously a slightly artificial how you choose to cluster the 25 techniques. The interesting thing about this study, though, really from a practical point of view, was it's shown, and I think this is the first time it's really been shown in an academically rigorous way, if you like. It's been shown that there are not an infinite number of ways of manipulating markets. There are a relatively limited number. And that means that if you're a firm worried about trying to control your risks and supervise your staff and your trading activity, you don't have to worry about every single thing that could go wrong. You need to focus on these 25 specific techniques, build systems and processes that will enable you to watch out for these patterns of behavior, because those are where the problems will arise.
Right.
Equally, if on the other side of the fence you're a regulator and you're thinking about how to conduct surveillance of markets, as you at the CFTC might, for example, then these are the 25 techniques that you want to be watching out for, because this is where the problems are likely to arise. So,
yeah, I was just going to say, what a great,
really interesting conclusion.
Yeah, what a great resource. Now, have you made that available on your website?
It will be published on our website, I think, on the 23rd of July, so just
wonderful.
In a couple of weeks.
Yep.
And it's going to be published in book form for those of you who prefer to read things that way. It's going to be published in book form in, I think, September, probably.
What an amazing...
Mark, are being done at the moment.
I was just going to say, I'm sorry to interrupt, but that is an amazing resource for not only the regulators, not only the banks, but for every law firm that's out there. And I think what's great about it is that it's part of the education that needs to continue to go on in this space to help people understand, okay, so this is the bad behavior that's gone on for a long period of time. And I think it's great to have that in one spot, but it's really good for people who are just coming into the industry, compliance people, lawyers, and so on, to give them the context of what's happened over time. Because too often, you have these big headlines of something being done, that's bad, and then there's a lot of focus on that, but you miss the broader context of, hey, that fits into this category. Here's what all these other people have been doing over time, and it's just an amazing resource. So that's wonderful. I really look forward to seeing when that comes out. And I'm one of those people that likes to hold stuff in their hand to be able to turn the page, underline things. I read a lot of stuff online, but it's just, I don't know what, I'm just an old guy, so I guess I like underlining things.
We'll make sure you get an autographed copy, first edition.
That would be great. Well, let's take a moment to just talk about some of the publications of the standards. I want to say there's, and correct me if I'm wrong, I think there's 13 and 14 that are up on your website already?
Yeah, so we've been running for 2 years. So in that 24 months, we've completed 13 altogether at the moment.
Okay.
And there are another 3 that are in that are in progress, and they are on our website, FMSB.com, for those who want to have a look at them, together with actually a lot of other material, speeches and links to other interesting websites, as well as these adherence statements that I mentioned earlier on in this conversation.
Right, and I think that's great for people who are listening. Go to their website, take a look at what their standards that they've already set up, that they're continuing to move forward on. I think that's very instructive, especially whether it's banks or clients. Definitely take a look at this. Let me wrap this up by going into the future a little bit. You just mentioned you're working on 3 other standards at this point, but what are you going to focus on, Mark, for the next 6 to 12 months?
Well, there are 3 broad areas that we're interested in for the next couple of years, say, and I would call them market conduct, market structure, and market regulation. So under market conduct, we are looking at specific issues that arise in the fixed income market of the sort that I was describing earlier on, where things are uncertain. It's not clear how conflicts of interest should be handled. So, for example, when you want to execute a large order in a market where there's limited liquidity, and you know that order is going to disturb the underlying market, how should you handle it? How should the buyer behave? How should the seller behave? How should the execution and reporting of that order be handled? Or in the case of the new issue market, how much information should be published in what way about the allocation of bonds in a new issue after the issue has been finalized? Or, for example, as we go through the process of reversing QE, the central bank purchasing of government bonds that's happened in the last 5 or 6 years, how do you handle conflicts of interest between own account or proprietary trading books at banks and client accounts in a reverse auction such as a QE unwind might be? Or if you're in a transaction, who's acting as principal, who's acting as agent? Is it clear all the way through the transaction what the agent or principal is going to do? Could it be the case that somewhere in the middle of the transaction, somebody who was purporting to act as principal turns out really to be acting as agent, and is it clear to the other side when that might happen? Those sorts of questions. So that's the first category. The market structure question is really all about electronic markets. The arrival of electronic trading is the single biggest structural change that I can remember in fixed income markets in the last 30 years. But it brings many, many benefits. I'm not in any sense trying to argue against electronic trading of fixed income markets, but it also creates some challenges. How high-frequency trading platforms use data, how this so-called last look opportunity that market makers have in some markets to change the price they've quoted after they've quoted it for their customers, how you handle latency arbitrage or flash events, circuit breakers, and how they're meant to operate in the markets. All these questions need to be fleshed out in more detail than they have been, and we're hoping that standards can make a big contribution there. And then thirdly, in terms of market regulation, we're concerned as a body that having been through a period of roughly 10 years since the last crisis, where most regulators around the world believed similar things about how regulation should be organized and what changes needed to happen in the regulatory arena to improve markets, we may be entering a much more complicated world now where some people have the view that the job's been done and perhaps national interests begin to have greater weight in regulators' minds than international convergence. And there's a danger if that is the case, and I'm not forecasting that it definitely will happen, but if it turns out that national regulation ends up diverging more from the international consensus in the next 5 to 10 years, then there is a danger for market users that clashes or contrasts between regulation in jurisdiction A and in jurisdiction B and jurisdiction C end up creating ineffective markets that don't work well for users. And someone needs to perform what I think will be an increasingly important role of holding up a mirror to the global regulatory community, pointing out where these ineffectivenesses arise and proposing solutions for regulators to consider that could fix them. It's rather like an international version, if you like, Andy, of the excellent job that I think the CFTC has already started on under your new chairman, of taking a look at the way in which regulation in the US can conflict with regulation in other parts of the world, and asking yourself the question, how could we change this to improve the experience for market users, but on an international scale.
Chair of Fixed Income, Currencies, and Commodities Standards Board, Mark Yallop, thanks for coming on today.
It's been a pleasure. Thank you so much, Andy.
That's our show for this week, and it has been a blast to have Mark Yallop on from the FMSB and hear what they're doing, especially their research into bad behavior over time. I'm really looking forward to seeing that. Remember, you can get access to all our shows we do here by either going on our website at cftc.gov or by getting out your phone, clicking on the podcast app, and typing in CFTC Talks. Click subscribe if you want to get them every week. I'm Andy Bush, Chief Market Intelligence Officer for the CFTC. You've been listening to CFTC Talks. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.